Have you ever looked at a maintenance bill for your rental and felt your stomach drop? The water heater dies, the tenant moves out, the paint needs refreshing, and then suddenly that month's profit is gone. But what if those costs were actually your secret weapon for long-term wealth? Imagine turning every maintenance bill into a building block towards millions in equity. You're listening to the Real Estate Fast Pass podcast, helping busy professionals fast track their way to passive income and long-term wealth through smart real estate investing. My name is Jake. I'm Jimmy's producer. As always, our host is the one and only Jimmy Vreeland, your Main Street patriot and your real estate investor in the trenches. Today, Jimmy is asking, are maintenance and make-readies killing your returns, or are they actually the best investments that you can make? In this episode, you'll discover why the way that you frame maintenance can make or break your investing career. You'll also find out the math that turns make-readies into double-digit ROI and the magic portfolio size that lets you stop sweating every tenant turnover. And also, Jimmy will reveal why the Roman Colosseum might be the ultimate cautionary tale for real estate neglect. So, if you're ready to flip your mindset and start seeing repairs as rocket fuel for your wealth, stick around. This is the Real Estate Fast Pass podcast.
All right, Jake, we're going to talk about something that weighs on the hearts and minds of every real estate investor, and that is maintenance and make-readies and how to view maintenance and make-readies.
Yeah, I always hear about this.
And so let me define terms for new investors. Maintenance is there's something caught in the sink, the toilet stuff, like the basic stuff you have to do to keep a happy resident in the house. And then make ready are the repairs, the paint you need to do, repair anything from the resident when they leave, when there's a tenant turnover.
Yeah.
Now, when I first started in this game, I have a mentor saying, hey, the greatest cost you're going to have in this business is maintenance and make readies, and you got to limit it. And now that I'm 10 years into the game, I completely disagree with that mentor.
Oh, really?
Completely and utterly disagree.
Why is that? Is that the biggest cost?
I kind of went through this evolution as a business owner. Like I used to look at overhead or payroll as an expense, right?
Yeah.
I look at it as an investment all day long.
Nice.
Like the people on my team continuing to get better, that's a straight up investment.
Yeah.
Only some like tightwad Scrooge would look at it as a expense.
Sure. So are you saying the same thing about make-readies and maintenance?
Make-readies and maintenance are resident reinvestments. So I guess maybe I've done something a little poor, but to experience that 5% appreciation, what do you think a reasonable expectation is that you're going to have to reinvest to experience that? Because think about it. The house you grew up in, your parents still live there?
I do. Yep.
Okay.
They've been there almost 30 years.
And so have they redone the kitchen? Did they repaint in the last 30 years?
Yeah. I remember this contractor screwed him over. I was probably in late middle school or something. And the back of the house where the kitchen was open to the elements for almost a whole winter because of this contractor. But we had bumped that wall out, expanded it, redid the whole kitchen. It was a huge investment for that house.
So it sounds like they needed to reinvest to experience the appreciation of the house. Now, I'm a direct-to-seller home buyer. I go into houses that haven't been touched in 30 years every day. And those sellers are actually in a negative equity position.
Right.
And then generally, I get a deal because of all the deferred maintenance.
Mm-hmm. Right.
We're open and honest with sellers. We're like, there's a ton of deferred maintenance here. Like, you're going to have to pay that out of your equity.
Yeah.
And so maintenance and make ready is not an expense. It's a reinvestment so you can experience the benefits of the four pillars.
Well, I like that you call it a reinvestment rather than an investment, because that definitely, there was uninvestment before. And so now you're correcting something from the past 30 years, right?
Yeah, I mean, one of my favorite videos where I kind of went viral on, I was in Rome with Susie, and we were going by the ruins of the Colosseum.
Yeah, I remember seeing this one.
Check it out. The Romans stopped doing maintenance, and look what happened. So like, if you think it's cool
They
to
didn't
never
do
do
their tuck
maintenance on your-
pointing.
What's that?
Said they didn't do their tuck pointing.
They didn't do their tuck pointing. They didn't do anything. They abandoned it and they lost the appreciation.
Right, right.
Like if they had kept that Coliseum up, that thing would be worth billions of dollars right now.
Yeah, it's funny. I saw a presentation from an architect who was talking about the new like Oakland Raiders stadium. I guess they're building it for LA. This was a couple of years ago, and that thing is literally modeled after the Coliseum. The retractable roof and the floor that comes out, so you can practice outside of the stadium, and then all these features. So super cool.
But like that new Las Vegas stadium, they're going to have to reinvest.
Right.
So to think you're going to experience benefits from the greatest wealth producer on earth, real estate, and not reinvest, it's insane. It's an unrealistic expectation. And I can't believe these thoughts are only occurring to me 10 years into the game.
Well, I definitely think it's a good thing to share, though, based on like that's a lot of times people's hesitation in this business or frustration. But they're surprised at how much actually maintenance and like turnovers actually cost.
Now, for people listening, if you're new, the average number is you're going to keep your first tenant. You're going to keep your tenant for 2 years and some change. And so those first few years when your houses are just cash flow positive, all that cash is going to go right back to reinvest in the house. Now, the cool part is that's not your original cash. That is cash from your residents. So the cool part about maintenance and make ready is like I have my rentals all in one account. And I have tenants coming in, tenants coming and going, maintenance coming and going. But that account just builds.
Mm-hmm.
And I'm not looking at it. Because if I look at it month by month, it'll drive me nuts. And it won't grow. You got to look at it once a year. And then I also look at the appraisal values. And then that's why I'm a happy investor.
So you said that average tenancy is actually 2 years?
2 years and some change. Now, I've had some tenants that are there 7, 8 years. Those are the bangers. Those are awesome.
Yeah. Yeah. Like, so love those, but expect 2 years. If you get one lucky, but it's just luck.
Yeah. And so run your math with keeping them for 20, 30 months.
Mm-hmm. Mm-hmm.
And so here's how I also do the maths on my tenant turns on the make ready. So generally I get about $100 increase in rent when a tenant moves out, and then I go in and redo it. Right. And that generally costs me $5,000 to $6,000. So let's just do simple math, $100 rent increase for a $5,000 make ready. So I'm going to make $1,200 extra dollars that I wouldn't have made for a $5,000 investment. That's a 21%, 22% return.
That's a great investment right there.
And so I don't know where else you can make that and get that return on that cash. And so let's go into story time a little bit. So I went through the books, and like we have like 30 people who have only bought one house.
Okay.
And like I think they're in a worse position than buying no houses.
Oh, really?
Yeah, I mean, because every maintenance cost hurts, every tenant turn hurts.
Yeah.
Like with my houses, I don't even notice when a tenant moves out because I got all the rent coming from the other houses.
Sure. Yeah. Yeah. It's spread out over all the portfolio.
Yeah. And so what happens is, here's where a new investor makes a mistake. They're like, hey, I'm going to do this. I'm going to try this, and I'm going to see how it goes. And then that is horrible. And then they have like a change order, or they have one make ready, or they don't have a tenant come in. Like this is real estate. There's real life, non-ideal stuff is going to happen. But luckily, real estate's like a bad haircut, and everything gets solved. And
I mean, if that's your mentality going into it, though, it's sort of like a self-fulfilling prophecy. I'm going to get into this and see how it goes, because what I don't want to see is, maintenance expenses and, the water heater going out or whatever. And then when it happens, you're like, oh, see, I knew this was a bad investment.
It's a self-fulfilling prophecy. That's a great insight. I'm going to start telling people that, because you're right. It's a self-fulfilling prophecy.
So then, as opposed to like sort of sticking to, usually like have that target setting call, that plan over a certain number of years, and then it's spread out over, right?
Yeah. And then anybody who's bought 5, I've never had him quit. I had one guy quit, but he made a couple $100,000 because he experienced so much appreciation. And he didn't really quit. He just reallocated capital.
Sure.
So the worst part to be is houses. And then this is why we sell to high income earners who are liquid.
Yeah.
Because they need to do 5 of these. Or if they don't have as much income and they're going to do 1 or 2 a year, they need to be committed to getting to 5 and then reevaluating. And then what's the worst downside? The worst downside is your down payment. That's it.
Yeah.
But now if you're looking at make readies and maintenance as a cost and a loss, you'll just be chronically unhappy.
Right. Yeah. No, that's interesting. It's a little bit like in the podcasting world. So most podcasts don't make it past 10 episodes, right? Like 90% of people quit before they get to 10. And so like, if you were like, well, let me just do 1 episode and put it out there and like see what people
let's see
think.
how it goes.
Yeah, like that's not the game. The game is the consistency. Like you'll see the return long after, you actually put it out. And so it becomes that self-fulfilling prophecy again. You're like, oh, well, like, no, this is an investment, right?
Exactly. And so I had a ton of fun with Kurt Gibb on the podcast. So I did some more digging into his numbers.
Oh, cool. Nice.
Okay.
Yeah, that was an awesome episode.
Yeah.
For people who haven't listened to it yet.
So if you guys haven't listened to it yet, Kurt he had an original investment of $451K. He's bought 19 houses and he's got a $1.2 million return. So that's a 276% return in like 5 years. So that's a 50% year-over-year return. Pretty sweet, right? Real numbers, by the way. Okay. Right. Now, you want to see the good, bad, and the ugly?
Yes, I do. No, that was an awesome episode.
He's made that $1.2 million return after paying $150K in maintenance costs and $50,000 in make-ready expenses. So he's had resident reinvestments of $200,000.
Dang.
And now he was one of my first clients. He bought early, and we've gotten immensely better. So I'm going to think his numbers a little skewed because we were learning.
Sure, yeah. Natural streamlining of processes and what have you.
Yeah. But
and he still cash flowed $142,000.
He still cash flowed $142,000, and he still had a return on cash flow 30%. And he still made that 1.2 after $200,000 in resident reinvestments.
Oh, that's after. Yeah.
That's after all that.
And he probably, to your point that you made earlier, which really hit me, you can't actually make that 1.2 without the reinvestment.
Without that reinvestment. Otherwise, just think about it. You just have the Coliseum.
Not gonna be able to sell that.
And then also think about it. The houses I'm selling to people are because of deferred maintenance.
Mm-hmm.
Like the house I live in now, we bought it on a short sale, and I'll never forget the inspector. And he's like, dude, this house is great. It's got great bones, just no one's touched it in 30 years. Accredited investors, if you're looking for quality real estate to put in your portfolio that is pushing 30 to 40% in annual returns, well, I'm glad you're watching this ad because I bring my investors about 400 of those deals every year, and all the due diligence is already completed. We also have all the lending lined up, and we have the construction and property management already set and ready to go. And it's all in-house, all done start to finish by my team. All you got to do is review the deal, write the check, show up at closing, and you're done. And the best part is there's no equity splits. You own the asset 100%. My team gets paid to do the things you were already going to pay for anyway, like having someone find the deal, fix up the deal, and manage the house for the long term or offload the deal for a flip. So if you want to invest in real estate and you want to build a portfolio on autopilot, or maybe just flip a few houses with a vertically integrated team doing all the work for you, A to Z, click the link. There's more information on how this works on the next page and the option to book a call with us to discuss working together. So cool. We got it at a huge discount, probably 40% of its value. Right. And then we had to come up with the cash to do the maintenance.
Yeah. Oh, dang. Yeah. So it's almost like it's to be expected, both the initial rehab, just to get to the point where it's, somebody can live in it, et cetera. But then like you should be definitely be expecting that there's going to be things that come up.
Yeah.
Just natural.
And then after going through all the maintenance stuff, we are pretty much spot on that 10% of the gross rents are going to go to maintenance.
Mm-hmm.
Now that, we have 1,000 houses and we're aggregating that data.
Yeah.
And then the make readies, the way I'm still running numbers on it, basically make readies cost 20% of the appreciation. So and then I started running all the numbers, and it looks like the make readies for the rent raises and the appreciation look to be about a 20% year over year. And then we'd have to be on we'd have to be going through numbers on a different type call where I could show people those numbers, but I'll probably do that video on YouTube.
Yeah, sure. So you're saying if in a given year,
well, and then the average tenant's going to stay for 2 years and some change, right?
right.
So do a $200,000 house. That house is going to appreciate 10% in those 2 years.
Mm-hmm.
So what is that? That's 20 grand. Cool. $5,000 make ready.
Yeah. So, in order to get that appreciation, you're going to have to reinvest a little bit.
Yeah, you have to do that reinvestment.
Yeah. Nice.
Because I've been on calls with owners and they're like, my make readies are too high. And I'm like, compared to what? I mean, like you want to benefit from inflation, but part of inflation is labor has gone up. It's part of the game.
Yeah. Yep. Yeah. And over time, it won't always be so high.
And so let's talk about a little bit of mindset.
Okay.
I see new investors coming in with this mindset. And I was like this, like a tightrope, like every dollar off of my monthly, what we used to call cash flow. Like if every maintenance cost is me taking a hit on my monthly cash flow.
Yeah.
So, when you walk a tightrope and you have any weight on it, the rope goes down.
Yep.
It would feel like a loss to me. So and then that's why people are white knuckling everything because they're counting every dollar because they're trying to quit their job from cash flow. And I mean, I've talked about that ad nauseum. It doesn't work.
Yeah. No, I it's kind of embarrassing, but so just last week, I was out on the South Dakota service project, which is really not so much for Lakota people, but more for like St. Louis high school kids. Because it's a time in their life where they need to like get out of themselves, right?
Yeah.
You're entering sophomore, you're a moron, right? It's typical. That's why we do this trip. But on the trip, I got frustrated because they're being stupid sophomore morons who aren't listening, who like get distracted, who, doing dumb things, getting in trouble. We literally had to call like search and rescue for 2 kids that like got to a place in the Badlands they shouldn't have gone.
Nice.
And I'm getting frustrated, right? Even though this is precisely like why we do this thing, right? And it just like it's hitting home for me exactly what you're saying, right?
Well, wait, we should do a podcast on this, but it's kind of like the Ann Sullivan gap in the gain. Like if you compare things to your ideal, you're going to be constantly disappointed. You always measure backwards.
Right. Yeah, exactly. And so like instead of like expecting that this was going to happen, right? That there's going to be like them being stupid and needing like correction and needing whatever, right? I'm getting frustrated, right? And the same thing like for our real estate investors who are like, they got the wrong mindset, right? Everything feels like a loss.
Even though I've been on case study calls where, I feel like I'm losing. I'm not cash flowing. I'm like, dude, you're up 400%. Come on. And so what I've done for myself, and I think the correct mindset is to look at real estate investing as like a snowball.
Okay.
Like Kurt Gibb right now, his 14 houses are a snowball. They're going to appreciate 5% a year. The rents are going to go up 5%. He's going to have some tenants move in. He's going to have some tenants move out. Mm-hmm. He's going to buy 1 or 2 more houses a year. And the momentum's just somewhat inevitable. He can't help but win.
Right. Yeah. I mean, it's like you explained before. At some point, like those mortgages get paid off, like the inflation sale takes flight, like this thing, like that's how it works.
I mean, and then I'm not a genius. I've just looked at what's created the most wealth in this country the last 250 years and tried to make a simple, stupid way to get people involved.
Yep. I really appreciate that. And one thing you said before actually really hit me about, I think it was actually in a talk you gave, not on one of our episodes here, that an undisciplined vision is a curse.
It's the worst.
Yeah. But like, if you just like stick to what works and like make that your vision.
Well, and the real danger we kind of talked about earlier in the podcast, the real danger for these people who I'm going to see what it's like is they lose sight of their vision. Like their job is to keep the eyes on the prize. Mm-hmm. The eyes on the prize is 20 rentals.
Right.
Like you get 20 loans from the government. It's your American duty to get those rentals. Go do your crypto, go do everything else, but you have to be snagging 1 of the 2 of these a year.
Yeah.
And then should I try to go through numbers on a podcast?
Yeah, sure.
Okay.
Give me a feel for what you've been seeing.
Yeah, the base. So if you're on the YouTube side, you see a picture of this basic rental that's hiding in plain sight, 3-bed, 2-bath in a place called Florissant, Missouri. I skipped through the year one pro forma because all you need to see is it's going to be cash flow positive. Doesn't really matter. It looks like $200 on this one.
All right.
So that house, we sold it to the buyer at 157. The 10-year value of the house is going to be $256K. The rent's going to go from $1,400 to $2,200. But the magic is this: the principal and interest payment is going to stay at $735. And what happens then is that's how the cash flow gap opens up. Rents get raised, mortgage stays the same.
Mm-hmm.
Like a third of the cost when you buy it is going to be the mortgage.
Mm-hmm.
And that's going to stay the same, and everything else is going to expand. So this one asset, it's going to appreciate about $100,000. The tenant's going to pay the mortgage down $20,000. You're going to experience the slow way, a tax savings of $16,000. Your year 10 cash flow is going to be $9,000. By the way, I don't run any of my numbers with cash flow till year 10 now. And your total return is going to be $146K on one asset. And when you buy a turnkey, it's a $15,000 down payment. You're going to have a 900% return in 10 years. It's stupid. So if you do it once, you should do it 20 times. So you'll get 1.9 in appreciation. Your cash flow for year 10, even if every dollar of cash flow goes to resident reinvestment in the first 9 years, your cash flow year 10 is $182K. Your equity pay down is $428K. And then you're going to get $300,000 in tax savings for a total return of $2.9 million.
Dang. Yo, so back to your Coliseum point here for a second. I just got the fact that you called it like resident reinvestment.
Yeah.
Right? It's like, the Coliseum's cool. I like to go visit it. Right? It's cool. And I think about all the Christians that were martyred there and what have you, right?
Yeah.
But I wouldn't want to live there.
But it'd be a lot cooler if they had kept it up to date.
Yeah, exactly. Like, but so resident reinvestment is like, yeah.
And that's the other thing. It's not money you would have had otherwise. It's not money from your job. It's money from the resident, the previous resident living there. And so another important reason, keep your eyes on the prize. For you guys just listening, to qualify as a one percenter, you know, those March on Wall Street people hate the one percenters, even though if you're in North America, you're in 1% of the world. Anyway, but top 1% in America, you have to have a net worth of 11.6. Top 2%, 2.7 million. If you have a portfolio of 20 rentals, you will have a net worth of 2.9 million. So passively, you can enter in to the top 2% of net worth of this country.
Passively. That's a pretty good deal.
Just because the Main Street Patriot, Jimmy, and his team are out crushing for you.
You just get to cast that inflation sail and sail right into the top 2%.
I don't know why people make it so hard on themselves. Keep your eye on the prize. Buy 20 of these. So if you want to enter the top 2% in net worth, if you want to get your 20 rentals, click the link in the podcast below, in the podcast, whatever it is that Jake sets up. He puts a link there. Click that link. Get on a call with me and my team. We'll get you moving. We'll get you started. If you also find value in this podcast, please like, share, and subscribe. Jake, thanks for helping me out on this one, bro.
That's it.
See you guys.